B&D, a company, it's a partnership firm in Nagpur, Maharashtra, is a wholesaler of the taxable product P, is a wholesaler of taxable product P, and an exempt product Q, is a wholesaler of taxable product P and exempt product Q. The firm supplies these products only in eastern part of Maharashtra. So they are making only intrastate supplies. All the procurements, both goods and services of the firm, are from suppliers registered under regular scheme. And the firm pays tax under composition scheme. The firm has opted for payment of tax under section 10 of the CGST Act 2017. B&D company has furnished the following details with respect to its turnover, exclusive of taxes and stock, exclusive of taxes. So turnover details are there and stock details are there. Say product P, it is taxable product. Product Q is exempt product. Turnover for the quarter ending 36 2018 is 40 lakhs and 14 for product Q is 14 lakh 65,000, and it is for quarter ending 39, it is 30 lakhs and 13 lakhs. And they have furnished the information relating to the stocks, say 25 lakhs and 10 lakhs, 10 lakhs and 2 lakhs. And stock as on 3110, it is 3 lakh 60,000 and 1 lakh 20,000 respectively for product P and Q. Now, the further information has been provided that entire stock of product P and Q are available with the firm on 39/2018 is purchased during the half year except a consignment of a product P valuing 3 lakhs which was purchased in April month in the preceding financial year. In the month of October, so all the stocks have been purchased within a period of 6 months, but except for product P, 3 lakh rupees stock that has been purchased in month of April in preceding FY. In the month of October 2018, no purchases were made. So no purchases were effected in the month of October, and products were sold at a profit margin of 20% on sales exclusive of taxes. So profit margin is 20% of the sales exclusive of taxes. And the extract of bill book maintained by the firm showed the following details. So on 110, 1 lakh product P was sold, 3000 Q was sold. Then again invoice 2307 on 110, 31250 and 2000 was sold. Likewise, a bill book has been provided for you. And the details of services availed by BD and companies as follows. Freight paid to GTA during the period April to October. Assume equal amount of freight is paid on each month on 10th day of the each month. Assume that the goods for which freight is paid on 10th day of the month, they have been transported between 11 to 20th of the month. So 1,40,000 is the freight amount of freight which has been paid from April to October for 7 months. That is 20,000 rupees per month. Freight has been paid, and same has been paid on the 10th day of the month. And special packing charges paid to packing company having expertise for such specialized packing during January to October. Now this has been from January to October. The packing charges are paid for the goods which were transported between 11th to 20th day of the month. as mentioned in point number 1 above, and the goods were packed on 10th day of the month and were transported from 11th onwards. Amount of the packing charges has been paid on 9th day of each month. So 3 lakh rupees packing charges has been paid, and the same has been paid on 9th day of the each month, and the packing charges for the month of January to October. All the above amounts are exclusive of taxes wherever applicable. So this information has been provided further. What they say is compute the net GST liability of BD and company for period April to October under composition scheme. Following calculations for each quarter, showing what calculations for each quarter separately, make suitable assumptions wherever required. Rate of CGST and SGST on service of transportation of goods is 2.5% each. And stock is valued at cost price. Stock is valued at cost price, and they are saying the rate of CGST and SGST on services of transportation. So in this case, if say reverse charge mechanism will be applicable, and composition supplier will be liable to pay GST on services availed from GTA under RCM. We cannot pay composition tax on the services of, say, transportation of goods. So CGST 2.5% and SGST 2.5% is to be required to be paid. We are required to compute the net GST liability. So first of all, say under composition scheme, is applicable till the aggregate turnover is up to rupees 1 crore, since this firm is located in Maharashtra. Firm is located in Maharashtra. Therefore, aggregate turnover of 1 crore will be taken into the consideration. Now here, in this particular case, for turnover for quarter ending 30/6/2000, say 18 is 40 lakhs for product P, 14,65,000 for product Q. So total turnover up to 30th September, say 2018, we presume it to be 2018 is what? Product P, product Q, because aggregate turnover is to be seen, therefore exempt as well as taxable supplies both will be considered in this case, and the turnover is, it is 40 lakhs, and for the next quarter it is 30 lakhs, 70 lakhs. Similarly here it is 14,65,000, and 13 lakhs. So it is 54, 65 and 43. That means what? 97 lakh 65,000. So here now the firm can effect further sale of product P and Q. This 1 crore minus 97 lakh 65,000 under the composition scheme. That is to be kept in mind. That is 2 lakh 35,000. Now the position of bill book states what? The position of the bill book is stating, say, they have effected the sales up to, say, 1st of October is 1,36,250. Then 58750. The cumulative sale is 1,36,250 plus 58750. That works out to be 1,95,000 here. Then as soon as the sale crosses this 45,000, it crosses the limits. So the turnover exceeds the limits of rupees 1 crore on 3rd October, say 2000. Hence, the company can pay, a firm can pay composition tax up to 2nd October only. Now we are required to compute the composition tax liability. Since it is a trader, only taxable supplies of goods will be considered. For determination of composition tax liability. And no ITC will be available during that period. So we'll be determining the output tax liability. First question is determination of output tax liability under composition scheme. So say quarter ending 30th June, quarter ending 30th September, and say quarter ending 31st December. Now turnover of product P will be considered. Turnover of product P is considered here. That is 40 lakhs and 30 lakhs. 40 lakhs, 30 lakhs, as well as say up to the second, this much. That is 1 lakh plus 31250 plus 43750. That is 1,75,000. That is up to 2nd of October. We have to consider the same because eligibility is up to 2nd of October. Rate of composition tax, that is 0.5% is CGST and 0.5% is SGST. So that is 20,000 will be the CGST element, 20,000 will be the SGST element. Similarly, for the quarter ending 30th September, it will be 15,000 and 15,000 and 875 and 875. Now, tax which is to be paid under reverse charge mechanism on GTA. The amount of freight is 20,000 per month. So it will be 60,000. Here also it will be 60,000, but here it will be nil because payment is made on 10th October and the company is not now covered under composition. So here CGST and SGST at rate of 2.5% and 2.5% respectively. That is 1500, 1500, here also 1500 and 1500, here it will be nil. So the total output tax liability including composition tax including tax paid under RCM, that is CGST 21,500, SGST 21,500, 16,500 and 16,500. So this plus this, this plus this plus this, and this plus this, and 875 and 875. So this is the, and what is the total CGST liability, which works out to be 21,500 plus 16,500 plus 875. So 38,875 and 38,875. This is the way we have to work out the total liability. So first part of the question is in relation to this. And in respect of packing charges, forward charge mechanism is there. So the supplier of the packing services will be liable to pay the GST on the same. We won't be entitled to take any ITC. Now, second part is keeping all the facts and figures of question number 12 unchanged. Compute ITC to be credited to electronic credit ledger of BD and company when it exists from composition scheme and becomes liable to pay tax under the regular scheme. So now they are asking us to find out the amount of ITC to be credited where in the electronic credit ledger. So in case if a company exists from the composition scheme, say on 3rd October 18, it is liable to pay tax under the normal scheme. So whatever inputs are there in stock, say you will these traders, so you will be whatever stock is lying with him on say 2nd of October 18, it will be entitled to take the credit of those stock. Besides this, it will be entitled to take the credit of the capital goods, and the capital goods credit will be allowed by reducing the same at rate of 5% per quarter or part thereof use. Similarly, if any purchases has been availed subsequently during the regular scheme, then also credit will be allowed of the same. Besides this, that must be kept in mind, purchases must not be made 1 year prior to the date when the company say switches to the regular scheme. So this is to be kept in mind. So that has been provided in section 18(1)(c). So first of all, the information is in relation to computers. The same have been purchased, will be eligible for the credit. Then printers, they have been purchased 2 years prior to this. So you won't be entitled to take the credit of the tax which has been paid on printers, since purchases must be made within a period of 1 year. So this won't be eligible here. Then motorcycle used by the staff for collecting payments, that is also covered under the ambit of say blocked credits. You won't be entitled to take the credit of this motorcycle which has been used. It is coming under the ambit of block credit. Furniture and fixtures, will be entitled to take the credit of furniture and fixtures. Air conditioners, the same has been availed during the normal scheme, credit will be allowed of the same also. And exhaust fans which have been used in go down, credit will be admissible of the same by reducing at rate of 5% per quarter or part thereof of use. The company has not claimed depreciation on the tax component on any of the capital goods mentioned above under the Income Tax Act. All conditions necessary for availing ITC have been complied, and rate of CGST and SGST on them is 9% each. So fundamentally the question relates to what? Entitlement of credit. So in this case, we are required to compute the amount of credit to be credited in electronic credit ledger when the company exit from composition scheme and opts and regular scheme is applicable. So we are required to determine the amount of credit in such a case. Now, as per the provisions of section 18(1)(c), company will be entitled to take credit of inputs lying in stock, or say inputs contained in say semi-finished goods or finished goods lying in stock, as well as capital goods on the day immediately preceding the day when it becomes liable to pay tax. So when it becomes liable to pay tax under regular scheme. So you have to work out the position of the inputs on 2nd of October. Whatever inputs are available in stock after reducing the sales of 2nd of October will be entitled to take the credit. Whatever goods are available, say on 2nd of October after, say, considering the sales of the same. So besides this, you have to keep in mind that ITC on supplies of inputs, capital goods, shall not be available where the invoice relates to 1 year prior to the date of, say, switching to normal levy. So if invoice is for 1 year before that particular date, you won't be entitled to take the credit as per the provisions of section 82. Purchases must not be effected 1 year prior to that date when we are going for the normal scheme. So first of all, you have to work out how much amount of the inputs are there as on 2nd of October 18. So position of stock of goods on 2nd October 18 after the sales have been effected. So how much stock was there of product P? Stock as on 39 is 10 lakh rupees. Stock as on 39, say 2018, product P is only taxable is 10 lakh rupees. Purchases made during the month, during this period, from 1 October to say 2nd October, it is nil, less cost of goods sold, product B, how much sales have been effected of product B, that is to be kept in mind during these 2 days, that is 1,31,250 and 43750. 1 lakh plus 31,250 plus 43750. This sales have been effected. And there's a profit margin of how much? 20% of the sales. So cost will be into 80. This will give you the cost. So the cost is how much? 1 lakh plus 31250 plus 43750. 80%. 1,40,000 cost of goods have been sold. Therefore, stock of goods as on 2nd October is 8,60,000 less stock of goods which have been purchased on in April, say 2017, since it relates to a period of 1 year prior to the date when company goes for a regular scheme. You won't be entitled to take the credit. 3 lakh rupees stock has been provided for the same. It has been given in the information. This information has been provided to you that entire stock is with the firm on this, is purchased during the half year except consignment of product P 3 lakhs which was purchased in April month in the preceding financial year. So you won't be entitled to take the credit of the same. So stock is 5,60,000. Stock is there of inputs. Eligible for credit, and they're saying rate of GST is 18% is the rate of GST. CGST at rate of 9% and SGST at rate of 9%. So you'll be getting the credit of how much amount? 5,60,000 into 9% and 5,60,000 into 9%. So this must be the amount of credit in relation to the inputs. Say 5,60,000 into 9%, there is 50,400 and 50,400. This is the amount of credit in relation to inputs. Now, amount of credit in respect of capital goods. Amount of credit in respect of capital goods. So purchases computers, they have been purchased on 1st October, say 1st of February. 2 lakh is the value and 36,000. So we'll be reducing it at rate of 5% per quarter. So January, February and March is 1. Then April, May, June, that is the second. July, August, September is third. And October, that is, even if it is half also, part of thereof we have to consider. So January, February, March, April, May, June, July, August, September and October. So it works out to be for 4 quarters. So first of all, computers. GST paid is how much? 36,000 rupees. less reduction. $36,000 into 5% into 4 quarters, that is 7,200. So 36,000 minus 7,200 is equal to 28,800, which includes CGST and SGST. CGST element is 14,400. SGST element is 14,400. Then printers, since they have been purchased 2 years before, printers, no credit will be admissible in respect of those printers. Being more than 1 year old, no ITC on printers. So you won't be entitled to take any ITC on the printers. Then next is motorcycles. Motorcycle, the same will be coming under the ambit of blocked credit. You won't be entitled to take any credit of motorcycles. It is coming under the ambit of blocked credit under section 17(5). Then is next is furniture and fixtures. Furniture and fixtures, GST is 72,000. They have been purchased on 12/6. So it is April, May, June is 1 quarter, July, August, September, October 3 quarters. 72,000 less reduction at rate of 5% for 3 quarters. 72,000 into 5% into 3. So 72,000 into 5% into say 3. 10,800. So this works out to be how much? 61,200 divided by 2, that is 30,600 and 30,600. Air conditioners. Next is what? Air conditioners which have been used in office. Here, full credit will be admissible, but same will be computed separately because they are asking on the position on 310. As purchases have been made after 310/18. Exhaust fan. It has been purchased for 9,000. Less reduction will be how much? Of 5% per quarter. Purchased in 10, 3, 1, 2. The 4 quarters will be there. So 9,000 into 5% into 4, 1800 reduction will be there. So this amount works out to be how much? Minus 1800, 7200. 3600 will be the CGST element and 3600 will be the SGST element. So amount of ITC to be credited to electronic credit ledger in respect of capital goods. So this much amount of ITC is to be credited in respect of capital goods, that is 14,400 plus 30,600 plus 3,600, that is 48,600. 48,600. And in respect of inputs it was 5,400. So total amount, total ITC on inputs and capital goods. Say on it works out to be 99,000. This is 99,000. So this was the information, this was the part. Second, that keeping all the facts in question number 12 unchanged, compute ITC to be credited to electronic credit ledger of BD and company. So you will be entitled to take the credit of the stock which is being held by you on 2nd of October, since you will pay normal tax with effect from 3rd of October. Besides this, will be entitled to take credit of the capital goods which are eligible capital goods. And if purchases has been made 1 year prior to that date, you won't be entitled if invoice is for that period. So in relation to inputs, 3 lakh purchases were made, say in April 17, won't be entitled for credit. And in relation to capital goods, printers, they won't be eligible for credit. And motorcycles, that is coming under the ambit of block credit. Air conditioners, they are purchased after you are paying tax under regular scheme, so full credit of the same will be admissible. Now question number 14 is also in relation to this, say this only, keeping all the facts and figures of question number 12 and 13 unchanged. Compute the GST liability as a case may be for the period which has been covered in under regular scheme. Now we have to find out the GST liability for the period under regular scheme. So we have to find out the liability in relation to what product B, and as well as whatever is the reversals which we will require to make, because product Q is what exempted. So whatever common credit reversals will be there, that is to be kept in mind, and accordingly we will be paying the amount of tax under regular scheme. Beside this, GTA services, we have to pay tax under the regular scheme, and that is under reverse charge, that is also our liability. The same is to be paid in cash. And admissibility of the credits, that is to be kept in mind in this question. Now first of all, we have to find out how much sales have been effected of product P and product Q under regular scheme. So here, sale of, say, product P under regular scheme and Q under regular scheme. Under regular scheme, as they have said that no purchases have been made in the month of October, So how much cost of goods which have been sold, that is to be worked out. They're saying stock as on 39 is 10 lakhs, as on 31/10 is say 360. So it is 10 lakhs product P and it is 360 at the end of the month on 31st of October. So 6,40,000 rupees stock has been sold, cost of goods sold. Profit margin is 20% of the sales. So 100 is if the sale element, 20 is the margin, cost is 80. Therefore, it's what? 25% profit is there of the cost. So that works out to be 6,40,000 into 25% is 1,60,000. So the total sales which have been affected is say 8 lakh rupees sales have been affected during this period, out of which under composition scheme is 1,31,250 and 43750. So it is 1 lakh minus 1 lakh minus 31250 and minus 43750. So how much amount of sales have been affected of product B? Minus 1 lakh minus 31250 and minus 43750. 6,25,000 is sale under say the regular scheme of product P. Q also has to be worked out because we are to be working the amount of input tax credit on inputs or say input services or say capital goods which are used for supplying both the taxable as well as say exempt supply. So it is input services and capital goods. Reversals will be required. So 2 lakh minus 120, 80,000 cost of goods have been sold. So how much will be the profit is 20% of the sales. So how much works out is 25% is say 20,000. 1 lakh is the sale of product Q under the normal scheme and under total sales, and under normal scheme works out to be how much you have to reduce the sales for first and second, and the sales for first and second is 3, 2 and 15. 3, 2 and 15 yani this is to be reduced. Minus 3,000, minus 2,000 and minus 15,000. So 20,000 rupees goods have been sold of Q. So 80,000 has been sold in normal scheme. So why we have worked out this? Because we'll be required to what? Reverse the credit. So in this case, so now we are required to determine the liability. First of all, we'll be working the reversals which will be required to be made in this case. What reversals will be required to be made in this case? We'll be working out the same. So amount of reversals. In respect of input services. Now, first of all, what input services we have availed and how much GST has been paid on those input services. That will be worked out. Common credit and reversals will be worked out. So first of all, CGST and SGST paid on services of GTA under reverse charge mechanism, which has been paid on 10th of October. So freight amount was 20,000 rupees. CGST element is 2.5%, SGST element is 2.5%. That is 500 and 500. This amount will be paid through cash ledger and subsequently will be eligible as credit. Eligible as credit. And reversals will be required accordingly. Similarly, CGST and SGST paid on packing services availed as ITC. So packing services under forward charge 3 lakh it was there, and it was for January to October, that it was for 10 months, means 30,000 each, and it is to be paid under forward charge and will be entitled for ITC. There's 30,000 and rate of GST is 18% here, 5,400, consisting of 2,700 and CGST and 27. So this much amount of input tax credit will be there in respect of services. That works out to be 3,200 rupees. And the common credit attributable to exempt supplies, common ITC on services attributable to exempt supplies, that is product Q, the same will be added to the output tax liability, will be added to output tax liability. That is 3,200 into turnover of Q, and we have worked out the turnover of Q is 80,000 rupees upon the total turnover. Total turnover of P and Q. P was, we have worked out the turnover of P as well as Q. Say under regular scheme we have find out that. P was 6,25,000. Q have already written 625 plus 80,000. So this way it is 3,200 divided by 7,05,000 multiplied by 80,000, that is 363 rupees. 0.12. CGST element is there and SGST element is also there of 363.12. Now in respect of capital goods. capital goods, the ITC claimed on capital goods on 2nd October 18, that was 48,600 CGST as GST element. Air conditioners were purchased during this period, and the credit element of the air conditioners was 36,000. So 36,000, which consisted of CGST 18,000, SGST 18,000. Full credit is admissible initially since it has been purchased on the month of October. So the total credit works out to be 66,600 and 66,600, and monthly credit taking life of capital goods as 5 years, 60 months, that is 1110 and 1110, and common credit, that is 60 months, TM. Common credit of capital goods, what is a common credit of capital goods? To be reversed, 1110 into 80,000 upon 7,05,000. That is 125 rupees 95 paisa, that is 126 here and 126 here. Now you can say work out what is the balance in your electronic credit ledger. Balance, say electronic credit ledger balance, the same is to be computed. ITC on inputs and capital goods as on 2nd October, which we have already worked out, that was 99,000. Then input tax credit on air conditioner, purchased in October. Input tax credit on air conditioner, which has been purchased in October, that is 18,000 and 18,000. Besides this, credit of the ITC on input services, that is GTA plus packing charges, and that was 3,200. 3,200, 500 plus 2,700, 500 and 2,700. So this much amount of ITC is available. Now you are required to work out the total ITC, that is 99,000 plus 18,000 plus 500 plus 2,700. So 1,20,000, 200 here and 1,20,200. Now determination of the output tax liability. Now the main question, that is determine, this was all working notes. Now you have to work out the determination of output tax liability. Determination of output tax liability, say under regular scheme. Product B, we have effected sales of rupees 6 lakh 25,000, in which CGST element is there, SGST element is there. That is at rate of 9%, 6 lakh 25,000 into 9%, 56250, 56250. Then tax on GTA paid on RCM, that is 20,000 into 2.5%, 500 is here and 500 is here. So total, say, output tax liability works out to be under RCM and this, that is 56750, 56750, as well as tax to be paid on common input service, capital goods. So input services, the element was 363 and capital goods was 126. 363, 126. So total GST liability that is 57239 and 57239. So 363 and 126 and 363 and 126, that is 57239 is the total liability, and less ITC. ITC balance works out to be how much? That is 120 to 100. Now we have to deposit GST to be deposited through electronic cash ledger. That is GST to be deposited through electronic cash ledger. ₹500, that is on CGST and SGST on GTA. It's always to be through reverse charge mechanism, always through cash ledger, that is to be kept in mind. And remaining GST to be used, to be paid through cash ledger, through credit ledger. That is 57239 minus 500, that is 56739. 56739. And the balance amount of ITC will be what? Carried forward. So this way you have to work out what first of all you have to work out how much amount of goods have been sold of product P under the regular scheme and product Q under the say regular scheme to find out how much of the input services and capital goods they have been used for effecting exempt supplies. So this way, this question is to be worked out. So very good question covering composition scheme, composition tax liability, then working out what the credits which are admissible as per the provisions of section 18(1)(c) when we switch from composition to normal scheme. Then in that then the other aspect is how much amount of output tax liability will be there under the regular scheme.